stock market is like a roller coaster. Thrilling highs, terrifying lows, and lessons at every turn. The Indian stock market has seen it all: booms, crashes, and rebounds. But what if I told you that studying the trends of these movements in the stock market, looking at what triggered the crashes and what encouraged these rebounds, has a lot of lessons for investors. Studying this, understanding this, will help all of us become a little more intelligent investors. So let's jump in and study that.
3, 2, 1.
Let's go.
Start with the most famous of this boom and crash, the Harshad Mehta era of 1992. The stock market crossed 4,000 for the first time, and investors felt that this boom would never stop. But behind the scenes, a big stock market manipulation scam was going on. And when this was exposed, the markets crashed, and overnight, fortunes were wiped off. Some key lessons from that era was that stock market manipulation was possible. So it's so important to study stocks diligently before going and investing, and not getting carried away by all the hype. And of course, SEBI tightened its control on the stock market to make it far more safer now than it was pre-1992. Fast forward to the late 1990s. The IT revolution was on in India. TCS, Infosys, Wipro was leading the charge, and the stock market surged past 6,000 in the early 2000s. And then the dot-com burst happened globally, and it impacted everyone, including the Indian markets. The markets corrected itself quite dramatically. Some key lessons from that era. Again, a hype-driven investing is also very risky, always risky. And diversify your portfolios. Investing in one segment itself can be risky. By 2008, the stock markets were smiling again. It crossed the historic level of 20,000 points. And then the Lehman Brothers crisis and collapse impacted the whole world. There was panic across the globe as markets crashed all over. The markets in India lost over 60%, and investors faced some huge losses. Some key lessons from that period. Even if India's economy is strong, the external global markets and the happenings across the globe can impact us. So keep an eye open for what's happening geopolitically outside. The second, don't make emotional, panic-driven decisions. Stay invested in some of these lows, and this could be an amazing time to actually invest, because the kind of growth you see after that is extremely impressive. And then came March 2020. Governments across the globe declared lockdown due to COVID-19. This was probably one of the swiftest, fastest crashes of the markets. Within weeks, the Indian market lost 38% of its wealth. And then the governments all took action, including the Indian government. They injected cash into the market, they cut interest rates, and within months we started seeing the recovery. This was again a very good period for investing. Some lessons from this period. Market crashes are normally temporary. They can vary from months to a year or more. But stay put and continue investing, and you can reap the harvest later. The second big learning is that governments can influence the markets, especially when it is in a panic stage and going down by stimulus packages, injecting money into the market and boosting the entire sentiment. By 2024, the markets had reached an historic level. It crossed 78,000. But as we came to the end of 24 and entered 25, the market started falling and lost almost 15% over the next few weeks, and it's still dropping as I speak. This was triggered by FIIs withdrawing money from the Indian markets, high inflation, and the overall global economy which had slowed down quite significantly. A few takeaways from this period is that the markets are rarely a linear line. They will always have a dip and then a rebound. This is both normal and also very healthy. Healthy because this is the period where the patient investor actually makes a big earning. The dips are the period when you can buy good stocks at far lower prices. Fortunes are made by the patient investor during this period. So clearly, the Indian market is full of opportunities. This is not the time to panic. For those who are willing to be patient, who are not emotional, who make extremely good buys when the markets are lower, are the ones who are going to make a fortune here. Some final pieces of advice. Don't follow the herd. Avoid hype-based investing. Stay invested for the longer term. The market rewards the patient. Be ready for the crashes. Tighten your seatbelt. This is part of the journey. And learn from history. Every peak and every crash has something valuable to teach us. Just before ending, I want to give an example of a purely mathematical calculation of how investing long term really compounds your money. If you had invested 10,000 rupees in the market post the 1992 crash, then today its value would be 3,90,000. I am attaching a calculation which is purely mathematical. But while you look at this purely mathematical exercise, do consider these. The markets were quite volatile during this period, experiencing serious ups and downs. The above calculation does not consider dividends. And if you had invested the dividend back into the market, that could have further increased your value. While the value of the 10,000 increased, but we have not corrected it for actual inflation. So the actual value of the money today would be far lesser, having corrected for inflation. In our calculation, we took an investment into a certain portfolio in the Bombay Stock Exchange. But if you diversify your portfolio, your returns will be far higher than what we calculate. The example highlights the tremendous value in being patient and being long term, and the markets as a potential investment tool, irrespective and more because of the dips and crashes that happen regularly. Think about this. This is just my investigation into the past history and my opinion of what I feel is the way to look at these crashes, since I see a lot of sentiment currently on the continuing fall in the Indian stock market. So stay informed, make unemotional decisions, and stay unstoppable.